All right, well, welcome everybody. This is 2021, January monthly market update. We put this all on the investor letter section at SimplePassiveCashflow.com/letter. But the free Easter egg for this month is you can go and download your free Bur Calculator, which I really don't like them. Don't like them at all. You can go to SimplePassiveCashflow.com/returns/hoot. RETURNS-HOOT is the URL to go and grab that free download. And while you're at the website, check out all the cool stuff we have on there. So this is more for accredited investors' point of view who used to buy turnkey rentals. But I think a lot of the kids these days under $500,000 net worth, they are out there buying these Burs, creating a lot of equity. But I just don't think it's the risk. First is risk of embezzlement with the contractors. These contractors hitting you with change orders, unforeseen conditions, and the bank doing a bait and switch on you for a lower appraisal value at the end of the day. I just don't think it's worth it. I think you see a lot of people having good success with it, but you don't see any of the downsides of it. But anyway, if you want to go ahead and do it, you might as well do it the right way and get your numbers right. So you can download that buy and hold analyzer and the Bur Calculator. But let's get to it. If you guys haven't joined our free Facebook community, look us up at Simple Passive Cashflow Hui is the Facebook group and also the YouTube channel. Join our community, interact with us. So first teaching point before you get started with the monthly report, I found this little check the other day. Actually, I keep it right here. Here it is. I have a screenshot if you guys want to take a look at it on the YouTube channel. But there it is. May 2011, I made a big mistake there to pay down my mortgage. Paid almost $5,000 to lower or pay down the debt of my mortgage, which is the worst thing you want to do. The debt's one of the best things of buying rental properties. And this is the way the government gets rid of their debt, by just inflating the money supplies so the debt is, less. Little did I know that sophisticated investors don't pay down their debt more than they have to. So I had John Burns on the podcast a few weeks ago. Great episode. He seems to be pretty bullish on all that's been happening. The Fed purchased $3 trillion in assets in 5 months. And this is depicted on this graph that I'm showed here. And I thought it was a big stimulus in 2008 after the Great Recession, but it seems like nothing to what got pumped in since the pandemic. So, if you're wondering why the stock market is at all-time highs again, well, I'm willing to guess that this is it. He likes the same markets that we all like, the year-over-year demand. Major markets, Houston's up there, Portland, Chicago, Philly, Washington, D.C. On the bottom, San Francisco, New York, Los Angeles. Another chart of the supply inventory has fallen year over year in nearly all top markets, with San Francisco and New York positive, which is in this one, you don't want that to happen. Some things that we got right. Bill Gates said that we were going to go through 10 weeks plus of extreme lockdown. He was right on that. But what he got wrong is we got a vaccine. He said it would be at least 18 months from now when a vaccine becomes widely available. And he also predicted that home buying would take a long time to recover. But I don't know where you're looking, but most markets, there's been a bit of a bump in the prices of real estate, mostly because of the high demand and low supply. A lot of us here are looking at the American billionaires who grew their net worth through this pandemic. That's what hardships and pandemics do. they separate the haves and the have-nots even more. So if you're out there, you guys gotta be on the offense, because that's what these guys are doing. They're pivoting their business. They're not feeling sorry for themselves. Last week, I have Jim Rickards on the podcast. He's known as a perma bear. He's usually pretty negative, but he was kind of going over some his new book, The New Great Recession or Depression, was all about how the GDP was going to be less than a couple percent points a year, which I thought was pretty good. His big thing is that you're not going to see 3%, 4%, 5% on average anymore. And the way I see it, well, perfect. If it's 1 or 2%, that's perfect for me. It's consistent. It's not like it's going negative. Maybe he just put that depression word on his book to sell, because that's the only way you're able to sell headlines and books these days, if you kind of proclaim doom and gloom and going to one side. So in this chart that I'm showing, he kind of pointed out the employment rate, which seems to definitely have bounced off the bottom, but it's not going to be that V-shaped curve that we've heard about. It's going to be more of a steady glide back to where we used to be. RealPage came out with a report where kind of depicting where the year-over-year resident change was the decrease, was the largest, and you're seeing a bloodbath out there in Seattle, Los Angeles, and San Francisco. You see a little green dot next to San Francisco. That's likely Sacramento, as people are trying to get out of the city, and Sacramento is just conveniently located nearby, which is probably why you're seeing that red dot there. But for the most part, people are getting out of these high-priced areas like New York, for example. Retention rates plunged 19.7% points year over year in San Francisco, 13.8 in San Jose, 13% in New York, 9.8 in Seattle. So you're seeing the exodus of these big cities, and the other ones that are hitting are Oakland, Boston, Los Angeles, Washington, D.C., and northern New Jersey. People are getting the heck out of town there. Where are they going? Well, it starts with T and it sounds like Tejas. So Hewlett Packard packs up, leaving California, going out to Texas. They made that filing back on December 1st. And it's kind of sad, because wasn't Hewlett Packard the one that kind of kick-started Silicon Valley? Well, now they're getting out of there. But how are multifamily or rents going? Well, 2020, we saw a negative to zero, essentially a 0% increase, which makes sense, right? I mean, we had a pandemic. You're not going to see the 2% to 5% rent growth that we've been seeing. This is from John Burns. He did a breakdown on majority of new single-family rentals tenants coming from urban areas. 59% are moving from urban locations, and 41% are moving from suburban locations. So people are generally getting out of the business core districts into the suburban locations, and that is where a lot of us will buy rental properties and apartments out there. 20 minutes outside of that city circle. A lot of times, in a large metropolitan area or big MSA, this is around the second highway loop surrounding the city. Multi-housing news says they defined the 2020 with 3 key multifamily investment trends, and those were: number 1, banner year ahead of transactions. This is because it's a lot less volatile year. We returned to somewhat normalcy by mid to late 2021. And I think 2020 was just a lot of gridlock. People just weren't able to visit properties, for one. They weren't physically able to go there. And a lot of people were just kind of frozen. Banks kind of froze too. So you didn't see a lot of those transactions. So I guess you're going to see a lot more action this year. Number two, the crowding of the Southeast capital markets as people, the overall trend is to get out of the Northeast and the coastal San Francisco, California markets. And thirdly, the temporary boost for the suburbs. I think we just covered that on the last slide, right? A remote working culture sticking around, coupled with the desire to live in less populated areas, will kind of drive this just outside the city. If you haven't heard or seen your stimulus checks arrive in the mail yet, but Congress approved a $900 billion relief package, and we don't really know what it unfolds for rental property owners or multifamily investors quite yet. But the way I see it, the money that goes to folks is going to somehow flow into investor pockets somehow. 25 billion is allocated for rental assistance, from which 800 million is being put aside for the Native American housing entities. According to summaries obtained by Politico, the package includes 166 billion in direct checks. I'm always following Blackstone, a big hedge fund group. I call this the smart money. They're not as nimble, right, as mom and pop investors, but they go after big assets, and I think they're good to watch. They picked up Ancestry.com, which is not a hard asset, which maybe some people are like, no, Lane, you're not buying fake assets, are you? Well, buying websites to me is something that I'm kind of interested in, because I see it as you're able to infuse value add, whether improve the content, improve the connections of the page, improve the readership, and make a lot of money. And it's a lot quicker turnaround. It also cash flows, which is what I like. A lot of these websites make recurring revenue or affiliate money somehow. What I don't like is it's virtual, right? I mean, you could make an argument whether a website and its brand means something tangible, but in a way it is. So, I mean, I'm kind of definitely looking into this. I'm in a mastermind with a lot of other SaaS business owners and Amazon fulfillment operators, and it's something I'm definitely have my mind on. A little bit of an Easter egg for you if you guys haven't checked out the virtual mastermind we are doing in lieu of the in-person Hawaii mastermind. This will be held on January 16th through the 18th. If you want more details, go to SimplePassiveCashflow.com/bubble. But we have almost 100 people signed up to this. It's going to be a pretty fun, good time. It's going to be a lot more high quality investors. Definitely not going to be your free get a bunch of beers, bro, happy hour real estate club. It's more for accredited investors and investors looking to become accredited very soon. So a lot of the topic material will be taxes and investing. And with a lot of high quality people, a lot of working professionals we have in our group. And that kind of ends the portion of the news this month. If you guys have any questions, submit a question at SimplePassiveCashflow.com/question, or you guys are welcome to type it into the Q&A box for those of you guys who join in live. But as we wait for questions to queue up, I'm going to be going over my little personal update this past month, and it is always themed to the 6 human needs from Tony Robbins. So the first, how did I get a little growth in my life? Well, doing something different. We're building some new multifamily apartments. We're trying to build a 230 unit apartment in Huntsville, Alabama. And it's very similar to what I used to do in my day job, but this is the first time where I'm like the owner and I don't have to submit documents or work to somebody else, to somebody else, to somebody else. So it's actually really exciting. I'm not just working for somebody. It's actually our project. So we just started to unveil or start to do some groundwork on it. Started to jump ahead of the rainy season. And here's some pictures of that. Number 2, contribution. How did I make the world a little bit better? Well, we just finished up the Remote Investor Incubator, which this is the incubator group. We have two masterminds. We have the one for mostly accredited investors. You guys can read more details on that at SimplePassiveCashflow.com/journey. But we also have an incubator group for newer investors trying to pick up their first remote rental. A lot of these guys are not accredited, and this incubator kind of connects them with the right people, takes them through the content, all the steps of buying a remote rental, and also puts them in a cohort with other people so they can team up. I had a great time doing this. It seems like I think we got like at least half of the people to buy their first rental, which is really cool. And I felt like we created a great little community. This incubator breaks up after the conclusion of I think like 5 months we've been together. We'll be looking to do another incubator group probably in February or March once the team takes a little bit of a break. But if you guys want to sign up for that, go to SimplePassiveCashflow.com/incubator and learn more about that. We also have the Remote Investor eCourse. If you want to kind of do your self-study on your own, we'll credit back what you paid for the eCourse if you sign up for the incubator later. Number 3, significance. At the close of the year, we have successfully purchased $460 million of real estate owned. And this is not just us as a part of another group. This is Huey Deal Pipeline Club. We buy our own deals just with us as the primary capital source. So that it was made possible from $50 million of investors like you. I think we have like about 400 investors currently who have put into deals, at least 50 grand into deals. 47 assets purchased, 4,200 units, 12 US markets, and our total group, a lot of you guys haven't jumped off the fence yet. I don't know what's going on. 4,000 people currently in our club, but again, only 10% have actually thrown in money, which makes sense. I mean, this is real estate. Money talks, and you know what walks, right? I don't know. I guess it was a hard year last year. People were a little frozen there. And that leads us into the next slide, which is uncertainty. How do we get uncertainty in my life? Well, I mean, this is a little concerning to me. I mean, unemployment has bounced back up, but it's nowhere near where it was back in 2018 and 2019. I think we'll get back there, but we don't know, right? $3 to $4 trillion pumped into the economy the last 6 months sure does help, but we don't know. But I guess you'll never know, right? And uncertainty is one of those things that is the spice of life that makes things worth living. The opposite of uncertainty is certainty. And what makes me very confident moving forward, aside from the fact that you go into deals at cash flow that aren't like house flips or Burs, you buy assets that cash flow day one, and you hope that a lot of this money, this fake money pumped in the system, will turn into trade winds to our backs and kind of power us even further. And you buy in the right markets that are trending upwards, and not New York, San Francisco, Los Angeles, which are experiencing the mass exoduses in mass. Lastly, how did we get a little love and connection, or how did I do that in a world of separation and mass, and I'm not allowed to leave the house? Well, the mastermind, the one-time annual mastermind, the virtual bubble, will be the January 16th to the 18th. If you guys want to join us, go to SimplePassiveCashflow.com/bubble. Early bird ends, I believe, on the 10th. So make sure you guys sign up before then. After that, I will be hard at work assigning breakout rooms for all the different modules. We're going to have a CPA lawyer, actually another lawyer, 2 lawyers, a syndication lawyer. We're also going to be talking, bringing in the experts in QRPs and self-directed IRAs to kind of let you guys talk to the experts. And to finish things off, stuff I bought this 1 gallon insulated jug, which I haven't been able to drink the whole thing all in one day yet. But This thing just cracks me up because it's humongous. A great use of $47.80 on Amazon. Again, if you guys want to go to get that Bur Calculator, go to simplepassivecashflow.com/returns-hoot. Or I think you can also go to simplepassivecashflow.com/returns. If you guys are listening to this, you got your cell phone around, you can text the word simple to 314-665-1767. Again, that's simple to 314-665-1767. And I appreciate all you guys coming. If there's no questions, we will close this out and we will see you guys next Monday.